This is Macro Horizons, episode 360, Dense with Suspense, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of February 9th. And as the Seahawks face the Patriots on Sunday, and NFP faces CPI in the week ahead, the next several days will be dense with suspense. We just watch it for the commercials. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, we had several key defining events in the U.S. rates market. Perhaps the most significant was that the market continued to digest the implications from Trump's nomination of Kevin Warsh to replace Powell. There's been a lot of conversations around Warsh's interest in attempting to shrink the balance sheet, although we suspect that that is a near or longer-term project, and the more immediate policy implications will be his approach to lowering rates at the June meeting. The market also absorbed the February refunding statement from the Treasury Department. Here we learned that coupon auction sizes were unchanged, as expected. In addition, Treasury has retained the several quarters language, implying that auction coupon size increases won't be on the table until next year at the earliest. Within the details of the refunding statement, it's notable what didn't happen. We didn't see a reduction in WAM, although that wasn't our expectations, and we also didn't see an increase in the liquidity buyback programs. Again, we were not expecting that, but based on the market's modest bear steepening reaction, some investors clearly viewed that potential outcome as a risk. On the fundamental side, there was a modest shift in the perception of the employment landscape. We had several key employment proxies that disappointed. First up was ADP, which showed payrolls growth of just 22,000 for the month of January. That was less than half of the 45,000 consensus and marked a downtick from the 42,000 in December. We also saw the highest weekly jobless claims figures since December at 231,000, and that brought the 4-week moving average up to a 5-week high of 212,000. Also of note was the Revelio Labs employment report, which showed non-farm payrolls dropped 13,000 in the week of January. The move was, quote, predominantly driven by losses in public administration, leisure and hospitality, and retail trade. It's also notable that this was a record low for this series, albeit data only goes back to January 2021. The market also benefited from challenger job cuts, which showed 108,000 layoffs announced in January, which was an increase of 117.8% on a year-over-year basis. This marks the highest total job cut announcements for the month of January since 2009. Therefore, it wasn't surprising to see the Treasury market rally as a result, with a clear bull steepening bias that brought the 2s10s benchmark curve back up above 73 basis points. We've been biased toward a steepening breakout for much of the year, and it would not be surprising to see 75 basis points in 2s10s challenged, which would put the 2s10s curve at the steepest level since January 2022.
While a government shutdown, or partial government shutdown, was a reality for just a couple days this week, that nonetheless means that we will have to wait until the 11th to get payrolls, and CPI has been pushed to, wait for it, Friday the 13th. What could go wrong? Instead, this week was far more about Treasury issuance and the follow-through of Trump's nomination of Kevin Warsh to lead the FOMC. What this means is that we are quickly approaching a new paradigm as it relates to both monetary and fiscal policy out of Washington, as greater collaboration between the Fed and the Treasury Department promises to be one of this year's, and frankly one of the Trump administration's most lasting impacts on the market. Despite Warsh's previously offered hawkish opinions during his former tenure on the Board of Governors, what we've heard from him so far is something of a departure from traditional thinking about monetary policy, and certainly what we'd heard from the likes of Kevin Hassett as it relates to the forward path of Fed funds and also the size and composition of SOMA. Specifically, Warsh has advocated for continuing to lower rates with an offered target of the 3% level, and more consequentially, he thinks that the balance sheet needs to be smaller and that the duration of SOMA's holdings should be much shorter than they currently are. Couple this with what we learned at the refunding announcement with no change to coupon auction sizes, and Besant seeing supply as in a good place for the next several quarters, emphasis S. And instead, our biggest takeaway from the quarterly update on the Treasury Department's issuance plans is that we're going to see more bill issuance, and a big reason why we're going to see more bill issuance is because the Fed is ready to buy them.
And as was one of our primary takeaways from the recent shift in Treasury borrowing focused on the bill sector, Besant has effectively forced the Fed's hand into monetizing the deficit. Now, the implications from this have arguably played out in the FX market with some of the recent weakness in the dollar. Although the dollar is certainly not at record lows, nor is the trajectory of the U.S. currency apparently troubling to the administration. And as a result, participants in the U.S. rates market appear content with the prevailing range in yields. Now, as we think about the evolution of the economic data, between now and the FOMC's March 18th meeting, it strikes us that the probability of a rate cut currently priced into the futures market is a bit low. We're not suggesting that the Fed doesn't ultimately pause again in March, but there's a lot of data between now and then, and there have been plenty of cross-currents for the macro outlook, which suggests that at some point in the next 5 weeks, the probability will drift higher, which will reinforce one of the key trends in the market at the moment, which is the curve steepener. With the 2s-10s curve pressing up towards the low or even mid-70s, we remain biased for a more significant breakout, presumably driven by a solid bid to the 2-year sector.
And ultimately, the biggest uncertainty, whether it's a Powell Fed or a Warsh one, is going to be how the early signs of growth optimism and, frankly, optimism around the state of the labor market, with the potential for a re-acceleration in hiring still not out of the question, ultimately materializes in the hard data. The biggest inflection we've seen in the collective mindset on the FOMC since summer was a shift away from concerns about inflation, and those concerns were made more pronounced by the introduction of tariffs on Liberation Day, to a realization that the upside to consumer prices as a function of tariffs has not materialized to a degree that was originally assumed. Part of that is a function of the fact that the actually implemented tariffs were not as severe as initially announced, and part of it is simply that the pass-through to end users was not as one-for-one as the Fed's economists were initially expecting. So this has left the dual mandate tilted in favor of worrying about the labor market. Now, what happens in an environment with a 5% growth backdrop in the United States, perhaps an inflection higher in confidence, and if not necessarily a re-acceleration in hiring, at least an unemployment rate that stays steady? It's this dynamic that we're hoping we'll get more clarity on over the next several months as the data impacts of the last government shutdown continues to fade, and we get a clearer sense of how the early 2026 economy is playing out. Another factor to consider, and something we've heard from Warsh as he prepares to take over in mid-May, is the potential for less forward guidance from the Fed. Whether that takes the form of ditching the dot plot or simply fewer Fed speeches during any given week remains to be seen, but from a market's perspective, if we're not hearing from Fed members every day or every couple of days, that's going to put a renewed emphasis on the data itself rather than the various hawkish and dovish interpretations of that data by FOMC members.
And further to Warsh's point, we have seen a dramatic increase in Fed transparency over the course of the last 2 decades. And with that increase in transparency, the market has come to understand the Fed's reaction function to the evolution of the data, at least in general terms. By streamlining or reducing the amount of communication and transparency from the Fed, we could see this translate into greater uncertainty in terms of expectations for monetary policy, and a reversal of the volatility dampening impact of that transparency. As such, comparatively, higher rates further out the curve make sense, and that will continue to reinforce our ongoing steepening bias. In the context of transparency and information coming from the FOMC, One of the major uncertainties remains whether or not Powell will retain his seat at the board once the new Fed chair is confirmed. All else being equal, given that Warsh has experience at the Fed and a meaningful amount of credibility in the market, we would expect that Powell would resign his board seat when his term as Fed chair ends. However, the Department of Justice probe has complicated this process and not only added the risk that the confirmation process is delayed, but also, at least marginally, increases the probability that Powell chooses to stay at the board through the end of his term in 2028.
And we've made it this far in the conversation without discussing the other big price action of the week, which is what we've continued to see in risk assets. And no, it's not a bear market in the S&P 500, but the drawdown in some software stocks, in tech more broadly, has reached the point of, at a minimum, desk conversation, but also the stage where the implications for financial conditions, while not yet pronounced enough to make it on the Fed's radar, are nonetheless relevant in interpreting the balance of risks around monetary policy looking out over the next few months. No, several 1 or 2% down days in the NASDAQ is not going to be enough for a policy error reaction from the FOMC, and nor have treasuries responded in a way that suggests the modest softness we've seen in equities is an indication of a more severe tightening in financial conditions just over the horizon. But in terms of what it means for the wealth effect and consumer confidence, middling equity performance is an important variable to consider in evaluating how consumption is going to evolve over the rest of the first quarter and into Q2. Clearly, Q4's growth numbers are going to be very strong, and so what remains to be seen is how the actual consumption impact from everything that's taken place in 2026 so far will influence the generally bullish outlook on the economy that we've brought into the new year. Aside from simply the outright level of risk assets, it's also important to remember the speed of any given move matters. A 10 or 20% repricing in the S&P 500 that takes place over the course of several months is a much different thing than one that takes place over the course of a few days. And as it presently stands, the price action in stocks is looking far more like the former than the latter, but nonetheless a risk to consider as we approach next week's data.
It's also worth highlighting that from the perspective of monetary policymakers, yes, financial conditions matter, but if one is concerned about the return of inflation in 2026, a modest de-wealthing effect would probably be welcomed by the hawks on the committee, at least because presumably it would translate through to lower demand for the upper 10% of households who continue to represent 50% of consumption for the U.S.
So another space to watch will be credit card delinquencies. After all, this country was built on debt.
Just ask Besant. In the week ahead, the Treasury market will be faced with several key developments which typically do not occur within the span of a single week. The partial and very brief government shutdown has resulted in a notable shift in the BLS's publishing schedule. Specifically, on Wednesday, we get January's payrolls report. The consensus there is for a 71,000 headline print with an unemployment rate of 4.4%. This release will also be accompanied by the annual revisions, and our expectations there are we will see another level set lower for the outright number of jobs added to the U.S. economy over the referenced period. In addition, we see on Friday the 13th, January's CPI report is now scheduled. Here, the expectations are for a 0.3% gain in headline inflation, as well as a 0.3% gain in core CPI. Overall, we expect that the inflation figures will remain benign enough to keep future rate cuts on the table, although it's unclear whether that translates through to the market actively anticipating a March cut. That, we suspect, will be a function of the non-farm payrolls print. It is notable that these two marquee data releases for the U.S. economy occur within a 3-day window, so it follows intuitively that we expect this period will be notably volatile and conviction relatively low. The market will also see the December retail sales print, and perhaps more impactful for flows and conviction will be the underwriting of the refunding auctions. We have 58 billion 3-year notes on Tuesday afternoon, followed by 42 billion 10-year notes on Wednesday afternoon, and 25 billion 30-year bonds on Thursday. The timing of payrolls, the revisions, and CPI will undoubtedly complicate the supply setup, and as a result, we expect that the need for a more meaningful auction concession will contribute to a steeper curve. We also see several key Fed speakers, Waller, Hammack, Logan, and Mirren, all of whom are voters and all of whom we expect will reinforce the notion that while the committee paused in January and there remains a fair amount of division between the hawks and the doves, that ultimately the FOMC will return to the process of normalizing rates. So we'll be watching for the incremental Fed speak to also reinforce the steepening trend by pushing front-end rates lower. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as we look toward the refunding auctions, payrolls, and CPI, we're reminded that what doesn't spark a sell-off only makes a rally. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.